Welcome into a daily editorial here on the KE Report. I am chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold, and we are recording this just a little bit before the Fed statement and Powell's press conference. But what we're going to do here is take more of a broad look and compare what's going on in the U.S. equity markets, also relate that back to the precious metals. First and foremost, Jordan, we have still, at least as we're recording this, U.S. markets at all-time highs. They broke out earlier this week, and they are holding these highs. They're not exactly screaming higher after that breakout, but just how important is it in your eyes to see, to understand that when we have U.S. markets at higher levels, all-time highs, the type of enthusiasm it takes away from the generalists, at least looking at the precious metals?
Yes, Corey, that's very important to understand. And the point I'll make is it's that type of situation it's most negative for the price of gold and not necessarily, or I should say less so for the price of silver and the gold stock. So that's a key distinction that people are going to have to remember moving forward, especially if this breakout in U.S. stocks has staying power. And, we see economic indicators start to rebound. That's something to keep in mind. So, yes, with the stock market breaking out to an all-time high, and we also see the stock market to gold ratio is having we'll call it a mini breakout here because it's just looking at the price action of the last several months. So gold versus stocks, that ratio is breaking down lower. So that is not the kind of technical environment where we're going to see a big move higher in gold in the precious metals complex. And, I will probably get to the Fed, but I'll just touch on it. If you look at what's been happening in the markets, Corey, bond yields over the last month or two, long-term bond yields, I should say, they've been rebounding. It looks like we have a double bottom in the 10-year bond, for example. And precious metals have been, correcting for the most part. And just, of course, the stock market's breaking out to a new all-time high. This action tells us that the Fed is done cutting rates and they're probably going to pause. So like I always say, watch the market carefully. The market is going to give you the clue before it comes out of the Fed's mouths. But of course, their words will move the market, but the market action is telling us that the Fed is probably done cutting and that they're going to pause here indefinitely, at least into next year.
Yeah, I completely agree with you on that one, Jordan. And I think they could have had a reason to pause this meeting, but I think everybody's expecting a cut this meeting, but then almost one of those hawkish cuts. We also got some data out this morning, jobs data or ADP numbers, as well as GDP that came in a little bit higher than markets expected. But one thing that's also important to consider is the sentiment data when it comes to U.S. markets. Right now, we have investor intelligence said that bulls rose to 54.2, and this is up from 52.8, so a little move higher, but this is closing in on a high of 55.3 that happened in October last year, so something to consider. And also the Fear Greed Index on CNN, that clocked in above 70 yesterday, and that is in the greed category. So we're seeing sentiment shift very much in the favor of the bulls for U.S. markets. I want to get your opinion on that, but I also want you to address what some of the, let's say, contrarians say is that when we get into these greed levels, it can turn around quite quickly. How do you balance these arguments out?
Well, it depends on the sentiment indicators that you're looking at, Corey. I think a couple of the ones you mentioned, like the fear greed thing, those tend to be more short-term in nature. When you look at things like fund flows, which are more of long-term indicators, now those are starting to rebound as the market breaks out to a new all-time high. But just in the last couple months, it was really astonishing looking at various long-term sentiment indicators and how basically sentiment and fund flows in the U.S. stock market were basically on the low side, despite the fact that the stock market over the last 2 years or 18 months or so has kind of been going sideways to slightly higher. So despite that happening, Corey, these long-term sentiment indicators that deal with moving money, basically, those were, I mean, in some cases they were near lows, other cases they were kind of in the middle of the range. But the overriding theme is basically these long-term sentiment indicators. You could say like about a month ago or so, they were telling us that a lot of money had already moved out of the market because they were fearful about a recession and a global recession. And look, where did that money go? It went into bonds for the most part, and secondarily, I'd say gold. And now we're seeing the reverse of that, where long-term bond yields are rebounding and money is coming out of bonds and money is going back into the stock market. And so there's a lot of buying power left to push the stock market higher. And, on another note, Corey, in recent months, we've been talking about, well, not we, but various financial media, they've been talking about the inversion in the yield curve, and this is really scary and bearish. And it is, but when you look at that, Corey, there's a lag. It could be as much as a 12 to 24 month lag. And so the point when the curve inverts up to the point where you actually get a peak in a recession, the stock market actually does pretty well during that period, whether it's 8 months, 12 months, 18 months. So we had that inversion, but there's basically a gap between the inversion and then when you get the peak of the stock market in the bear market. So we're in that period in between the two, and historically, that data is very strong that you do get a continued advance in stocks when you're in that gap between those two periods. So I'm not surprised at how things are playing out here with respect to the stock market. I mean, it's following history. The stock market's breaking out. We're probably going to see higher highs over the weeks and months to come. And, eventually that'll lead to a peak in a bear market. But, the market is just breaking out. So for this next move higher in the stock market, we're still in the early stages.
So then what is your thought on a recession? I've talked to a lot of people, and you know what? It's very much mixed. Some are saying next year the recession could come. But yeah, when we do see a yield curve inversion, that can be 2 years out. So do you think we will get a recession next year, or is this something that we do need to look into 2021 for and expect markets to rise up until then?
Yeah, so I would say just judging on how the market is acting and judging the various indicators and money flows and capital flows that we all watch, I would say a recession sometime in 2021 is looking far more likely than in 2020. But who knows? Maybe it could be at the tail end of 2020. Otherwise, I'd be surprised if it didn't happen in 2021. But yeah, just to reiterate, in the meantime, we're not seeing anything right now that is telling us a recession is imminent.
All right, let's also talk about sentiment when it comes to precious metals. The COT reports have been fairly interesting for gold, and we also saw money enter the gold market, but you know what? It seemed like it was very weak hands. They played that run up and now have generally kind of faded some of their positions. What do you take into account when you're checking out the sentiment, the COT reports for gold?
Okay, well, as you know, I measure the COT as a percentage. I measure it as a ratio between the net speculative position divided by the open interest in the market. And basically going back 20 years or so, the extreme readings tend to be when you get above 50%, especially when you're in that 55% range. The last like 3 major peaks in the gold price. So we're going with 2016, 2012, and 2011. All of those peaks occurred right around the 55% level as far as my reading of the COT. And the recent peak in the price of gold occurred right at about 55 or 56%. Now, as far as corrections in bull markets, this doesn't happen all the time, but the COT can bottom anywhere from 25% to 35% or even 40%. I want to see the COT come down to below 40%, kind of get in that 35%, 30% area. Now, the reading as of last Tuesday so that's basically 6 trading days ago, was 47%. So we have not seen much speculative money come out of the gold market yet, Corey, unfortunately. The gold price is obviously held. It's held in pretty well up until now. The daily sentiment index, I mean, that's come down. That's encouraging. But the COT is really more important because that's dealing with actual money in the market and people who actually have speculative positions in the market. And gold, looking at the daily price chart, it does. It had the recent low at the very beginning of October, at about 1470 or so. So if we see a move below 1470, we could see a move down to 1440, 1425. And when we get that break below 1470 or even 1480 on a closing basis, I think that's when you're going to see some of these spec positions start to come off. Then you'll see gold tumble lower to the mid to low 1400s. That's probably when you'll see the net spec position get to 40% or even lower. So that's something to keep an eye on. As far as gold sentiment, I mean, I know that gold has held up well. The stocks have held up well. I know we'll talk about that next. But looking at the price of gold, Corey, I'm not bullish on that over the near medium term because of what we discussed with the stock market. And secondly, because of sentiment in the COT, it's telling us that more selling has to come, more money has to come out of this market. And I think that's something, we can see here over the winter.
Okay, but as you said, let's talk about some of the gold stocks, the juniors, and even the silver stocks. You outlined earlier that when the U.S. markets or equity markets are going up, then these sectors, so silver, some of the juniors, they can actually outperform the underlying metal and some of the larger companies. We have seen a bit of a sell-off in, let's say, SIL and GDXJ, but fact of the matter is they really haven't broken any key levels or anything. They've corrected quite naturally right here and not even really underperformed in the sense of correcting to a greater degree than, say, the large gold stocks. So does that mean that we're going to be in this environment for a little bit longer where, some of the gold stocks hold up, the silver stocks hold up, the U.S. markets go higher, but we see still a little bit of that fade in the underlying metals prices, even to those levels that you just shared in terms of gold?
Yeah, absolutely, Corey. It's very possible, and I mean, I'll try and fit my answer here. I'll try and keep it short, even though this is something we could do an entire episode on. But first and foremost, Corey, fundamentally, the key to watch is what we've been seeing recently is obviously rate cuts have been the big driver for precious metals. Now, when the Fed's not cutting, what we need for precious metals is rising inflation expectations. If you look at charts of some of those things, they're starting to tick up, and we could be moving into an environment where the stock market does well, but people start to get concerned about inflation and rising inflation expectations. And in that environment, Corey, and by the way, this is what we had in 2017 for the most part, and a little bit of 2018. Stocks were doing well. Commodities like base metals, they were doing well, doing better than gold. But the key difference between then and what could happen in 2020, Corey, is we could see the Fed basically not hike rates. So gold did not do well in 2017, 2018, despite rising inflation expectations, because the Fed was hiking rates. This time around, if we get that, the Fed is not going to hike rates. And that means that you get a steepening yield curve and you get real interest rates that are declining. So that's the fundamental picture, Corey, that's bullish for precious metals. However, it's going to take some time for the market to move off of rate cuts are bullish to higher inflation, no rate cuts, that's bullish. It doesn't just happen in a week or two or a month. So the market has to transition from that narrative to the new narrative. It's going to take some time. That time is the correction going on in precious metals. But looking at the technicals, Corey, in that kind of environment, Corey, as I was saying before, I think you want to own miners rather than gold. You want to own silver rather than gold. And you probably want to own juniors rather than seniors. And so those are the things that I'm going to be watching, over the weeks and months to come, Corey. Basically, the gold silver ratio. I'm watching for silver outperforming gold. I'm watching the mining stocks. Are they starting to outperform gold? How are they doing against the stock market? And then the silver stocks. How are they acting versus the gold stocks? Because if you look at the performance over the last couple of weeks, Corey, the silver stocks have been outperforming the gold stocks. So that is one good sign. And also, the GDX advanced decline line has actually been pretty healthy. It has been showing a positive divergence. So it's kind of confusing because there's a lot of things going on, and we're kind of shifting between, rate cuts, recession, global recession, to a little bit of a recovery and reflation. So with all those things going on, I'm going to be keeping my eye on the mining stocks, how they're performing. Are the silver stocks outperforming the gold stocks? Is silver outperforming gold? So those are the things that we really need to watch for, Corey, over the next couple months. So it's going to be kind of interesting and exciting to see if we can see the gold and silver stocks continue to hold above their lows and continue to base, because look, in the next couple months, Corey, they don't have to run up and break out. If they can just hold these recent lows and continue to consolidate and digest their recent gains for another 2, 3, 4 months, they're going to be setting up a very, very bullish consolidation for an eventual breakout sometime next year. But as far as where we are right now, next week or next month or two, there's no threat that precious metals are going to break out to the upside here.
All right. Yes, it's all part of this process. And you know what? It's been a nice start to, let's call it, the bull market for the precious metals. But right now, nothing moves in a straight line. And that's why I think we're going to see a slightly more hawkish Fed and even this bounce in the U.S. equity markets. That does take some steam off of the underlying metals price, but that does also bring some more risk tolerance into the markets, which is still the juniors and even some of the silver stocks. So, hey, it might take some time, but you know what? Next year should be very interesting as we even get through this year, too. You know what? Things can change very quickly, but right now we do need to take into account where sentiment is and where money flows are going. And right now it's been a little bit away from the precious metals, but it's still been a very good year so far for the precious metals. Jordan, great chatting with you. Thanks for sharing some of your insights today. Have a great rest of your week.